In May 2026, the television shopping network QVC found itself in a legal battle, not with a competitor, but with its own shareholders. At the heart of the dispute was a proposed debt restructuring plan, designed to cut hundreds of millions of dollars from the company's financial obligations. Shareholders accused QVC of attempting to divert approximately $500 million in assets to its creditors. This move, they argued, effectively stripped value from the equity holders, leaving them with little to nothing as the company navigated its insolvency case. The core issue was a legal maneuver known as debt-for-equity swap or similar restructuring, often used to save financially troubled companies. However, the specific terms of QVC's proposal triggered alarm bells, suggesting an imbalance in favor of bondholders. Historically, QVC, a subsidiary of Liberty Interactive, had been a retail powerhouse, pioneering televised shopping. But shifting consumer habits and the rise of e-commerce had steadily eroded its market position, leading to mounting debt. The proposed restructuring aimed to reduce this debt burden, theoretically allowing the company a fresh start. But the method chosen, according to the shareholders, was overly aggressive, prioritizing debt repayment at the direct expense of equity. This isn't an isolated incident. In distressed situations, the battle between equity holders and creditors is common. Creditors, holding the company's debt, typically have priority in bankruptcy or insolvency proceedings. However, shareholders argued that QVC's plan went beyond standard practice, constituting an equitable subordination where their claims were unfairly pushed down the priority ladder. They claimed the company was effectively giving away their value. The Bloomberg Terminal reported on these accusations, highlighting the legal filings where shareholders sought judicial intervention. Their goal: to prevent the transfer of assets and ensure a more equitable distribution of the remaining company value. The outcome of such disputes can set precedents for how distressed companies restructure their finances. It underscores the delicate balance between saving a company and protecting the various classes of investors. So what does this mean for you, the investor, when a company you own shares in faces financial distress? How do you protect your stake when the corporate structure begins to unravel? First, understand the capital structure. Before investing in any company, especially one with significant debt, know where equity sits in the priority stack. Common stock is always last in line during liquidation. Second, monitor debt covenants. Companies often have agreements with creditors that trigger specific actions if financial metrics decline. Use financial news services, like a Bloomberg Terminal if available, to track these clauses. Third, cap your exposure to single customer or single channel businesses. QVC's struggles highlight the risk of over-reliance on one distribution method. Diversify your portfolio to mitigate sector-specific downturns. The single strongest takeaway: always read the fine print on a company's debt offerings and financial statements. The devil, and your investment's fate, is often in those details when a company is on the brink.